Hello, this is Harjinder, and in this video, we're going to talk about topic 7 for advanced financial accounting, consolidation after acquisition date. Now, for the parent company, when it's looking to account for its investment in the subsidiary, after acquiring the subsidiary, the parent has two choices for accounting for its investment. It could use the cost method, which is fairly simple as far as internal record keeping goes, or it could use the equity method, a little bit more work, but then it also produces a standalone income statement for the parent company that would incorporate all the outcome of consolidation as well. Now, for financial reporting purposes, it is important to keep in mind that the parent company has to prepare consolidated financial statements. So when we speak of the cost method or the equity method, those are choices for internal record keeping. The parent company cannot use the cost method to report its investment in the subsidiary. So that's an important thing to keep in mind. As I was mentioning, the cost method is simpler compared to the equity method, and it's fairly common for companies to use the cost method for internal record keeping, and for consolidation, adjustments have to be made to the cost method records. On the other hand, the equity method captures the net effects of adjustments that are needed for consolidation, and one could argue that maintaining records following the equity method possibly makes for easier consolidation, or at the very least, the separate company books of the parent company will reflect the outcome of consolidation as well. So users may find the equity method a little more informative compared to the cost method. Now, a quick look at consolidated financial statements. The parent company has to, for financial reporting purposes, prepare the following consolidated statements: the consolidated statement of comprehensive income, or consolidated income statement under ASPE, the consolidated statement of changes in equity, or under ASPE, the consolidated retained earnings statement, the consolidated statement for financial position, which is basically the consolidated balance sheet under ASPE, and the consolidated statement of cash flows. Of course, it goes without saying that additional note disclosure is also needed. For purposes of this course, a typical consolidation problem that you will encounter will not be reflective of real life. So what ends up happening in a typical consolidation problem is that you're required to reconstruct the consolidation procedures from the acquisition date to the current, i.e. the reporting year. Now that doesn't happen in real life at all. You will have access to last year's consolidated financial statements, last year's working papers, and so the actual act of consolidation is not, I would say, as exhaustive as would be if a typical course level consolidation problem were to ever surface in real life. Now, what ends up happening is that you're typically given information related to the date of acquisition, intercompany transactions that may have happened in the intervening years, and you're also given financial statements for the current year. And typically, you're told that the parent company uses the cost method to account for its investment in the subsidiary. In most cases, if you're not told otherwise, you will be using the fair value enterprise method to account for non-controlling interest. Sometimes you are asked, or you're rather directed, that the parent uses the identifiable net assets method for accounting for its investment, rather for non-controlling interest. And if that were the case, then you should be prepared for it. But most examples will have the fair value enterprise method to account for non-controlling interest. And usually, we are only asked to prepare consolidated statement of comprehensive income and the consolidated balance sheet. So we're not typically asked to prepare a consolidated statement of changes in equity and the consolidated cash flow statement. Now, in a typical consolidation question, you will go through the equivalent of 10 steps, beginning with step 1, identifying the acquirer, the acquisition cost, and the non-controlling interest on the date of acquisition. You also calculate the acquisition differential and goodwill. Step 3, we prepare an acquisition differential amortization schedule. Step 4, we identify intercompany revenues and expenses for elimination on the consolidated statement of comprehensive income. Step 5, we identify intercompany balances, receivables, payables that must be eliminated on the consolidated statement of financial position. Step 6 is where we identify intercompany profits resulting from the sale of inventory and assets. Now, these intercompany profits, if they had been held back in a previous year, may have gotten realized in the current year if the asset was sold to outside parties or by way of depreciation. Or these profits could relate to transactions that occurred in the current year and are still unrealized. So we have to be able to identify if the intercompany profit was realized in the current year or if it was unrealized and occurred in the current year, because those will then trigger adjustments in the following step. In step 7, we do an independent calculation of the consolidated net income. The idea here is we not only calculate the consolidated net income, but also compute the portion of the consolidated net income that will be attributable to the shareholders of the parent company and non-controlling interest. In step 8, we calculate consolidated retained earnings that will be reported on the consolidated balance sheet. In step 9, we calculate the non-controlling interest amount to be reported on the consolidated balance sheet or the consolidated statement of financial position. And in step 10, we prepare the consolidated financial statements. Looking at steps 1 and 2, we've seen these steps earlier, consolidation on acquisition date, which was covered in topic 6. Step 1 is about identifying the acquirer, the acquisition cost, and non-controlling interest on the date of acquisition. Recall that sometimes when the business combination is completed by way of exchange of shares, the outcome might be a reverse takeover. Most problems that you'll come across will not throw that curveball at you. So in most cases, it is going to be a straightforward situation where it is fairly simple to identify the acquirer and the acquisition. And step 2 also you would have looked at in topic 6, business combinations, is where we calculate the acquisition differential and allocate it to fair value differences, with the difference being allocated to goodwill. Step 3 is the acquisition differential amortization schedule. Now, we've seen a variant of this in topics 4 and 5 when we were dealing with investments in associates and investments in joint ventures. So the idea is that the fair value differences that were identified on the date of acquisition become amortized over time. And that happens over the remaining useful life for assets and the time to maturity for liabilities. Now, for liabilities, it is important to use the effective interest rate method However, for purposes of this course, we will keep it simple and use the straight line method of amortizing any fair value difference related to liabilities. Goodwill is not amortized, but is tested for impairment, and if it's found to be impaired, must be written down. What ends up happening is we prepare an amortization schedule for the acquisition differential, which looks something like this. So you will have a table that has, well, 5 columns, starting with the individual items, with the fair value differences and goodwill, because fair value differences and goodwill added together gives us acquisition differential. The second column will have the balance on the date of acquisition relating to the fair value differences and goodwill. And then we have 2 columns that deal with the amount amortized or impaired. Now, the 2 columns, the first one is the amount of amortization of the fair value differences and goodwill from the date of acquisition up to the beginning of the current year. One could argue end of last year. Basically, consolidation is done at the end of the reporting period, so up to the end of the previous year. And the next column has the amounts pertaining to the current year. So the amount of fair value difference or goodwill impairment that is to be charged for the current year. The last column is the amount, the balance that remains unamortized at the end of the current year. So the balance on the date of acquisition should, the total of that particular column should correspond to the total acquisition differential calculated in step 2. The amounts in the second column or third column, as you look at it, the amount that is accumulated up to the beginning of the current year is something that we use in calculating consolidated retained earnings in step 8. The amount for the current year is used in step 10, calculating the consolidated income statement. And we also actually use it for step 7 when we calculate the consolidated net income. And the balance that remains at the end of the current year is used in steps 9 and 10. So looking at the amortization of fair value differences for items relating to current assets or current liabilities, so stuff like accounts receivable, inventory, accounts payable, and such like, the fair value differences are assumed to be eliminated within a year from the acquisition date, i.e. the fair value difference is amortized within a year from the date of acquisition. For depreciable assets, these are amortized over their remaining useful life at the date of acquisition. So if on the date of acquisition, the depreciable asset had 5 years remaining, then the fair value difference will get amortized over 5 years. For non-depreciable assets, we do not amortize the fair value difference because there is no depreciable period, but rather we test them for impairment. So if there was a fair value difference relating to land, land is a non-depreciable asset. The fair value difference relating to land is not amortized. It is tested for impairment. Or another way the fair value difference could clear out is if the said land were to be sold by the subsidiary to an outside unrelated party. For long-term liabilities, these should be amortized using the effective interest rate method, and an amortization schedule must be prepared for any discount or premium. For this course, we are going to keep it simplified and use the straight line method. Finally, goodwill is not amortized, but it's tested for impairment. And in a typical problem, you will have information related to the impairment amount, either given specifically to you or you're given some helpful information to determine the amount. Step 4, identifying intercompany revenues, expenses for elimination. So intracompany transactions are transactions that occur between the parent company and the subsidiary. These can include intracompany sales and purchases. They can include charging of intercompany management fees, intercompany rentals, royalties, interest on loans made between the companies, et cetera, et cetera. These transactions are eliminated when preparing the consolidated statement of comprehensive income. If revenue is recorded by the parent, we call this a downstream transaction. If the revenue is recorded by the subsidiary, it is called an upstream transaction. So once again, you have the parent company and the subsidiary. If the parent company records revenue, it's a downstream transaction. If the subsidiary records revenue, it's an upstream transaction. This is important to note because the direction of the transaction will have a bearing for which part of the calculation must an adjustment be made. So if the transaction is downstream, we'll make an adjustment to the parent the numbers for the parent company. If the transaction were upstream, then we'll make an adjustment to the subsidiaries numbers. So the directionality is important to note. Step 5, intercompany receivables, payables. These are also called intercompany balances. So intercompany transactions, as I was mentioning, can also result in amounts owed between companies. If one company owes money to the other, there would be a receivable and a payable. The company that owes money will have a payable recorded on its books. The company that is owed the money will have a receivable. Now, by dint of the fact that these two companies are part of the same reporting entity, the receivable and the payable related to the intercompany balances must be eliminated, i.e. gotten rid of, when we prepare the consolidated balance sheet. And these amounts are identified in step 5 specifically for the balances, step 4 for the intercompany transactions for the statement of comprehensive income. So just taking a look at the adjustments for intercompany transactions and balances. If we have an intercompany sale of inventory, we must subtract the sale amount from both consolidated sales and consolidated cost of goods sold. If intercompany management fees are in play, we will deduct the amount from other income and other expenses. If the subsidiary pays dividends to the parent company, we will subtract the amount of the dividend paid by the subsidiary from consolidated dividend income, or if that particular line does not exist, it will be in part of the other income. So we'll deduct it from other income. Intercompany accounts receivables and accounts payables must be eliminated by being deducted on the consolidated balance sheet from the accounts receivable and accounts payable. Step 6, the intercompany profits. So intercompany profits that arise from the sale of assets, inventory, or other assets between the parent and the subsidiary company are considered to be unrealized until such inventory or assets are either used up or sold to outside parties, similar to what we saw in topics 4 and 5 for the investments in associates and joint ventures. So typical intercompany items that will result in profits that need adjustments will relate to inventory, which remains unrealized until inventory is sold to outside parties. It could relate to non-depreciable assets such as land. So in this case, the profit remains unrealized until the land is sold to outside parties. And you can also have intercompany profits arising from sale of other assets such as equipment, building, patents, and so on. And in these cases, what ends up happening is the profit gets realized through use, i.e. depreciation over time, or if the asset were to be sold to an outside party. Looking at the adjustments for intercompany profits, first adjusting item is the realized profit in beginning inventory. Now, if there was ending inventory from the previous year, the profit in that ending inventory would have been considered unrealized. That ending inventory became the beginning inventory for the current year. Now, what happens is inventory gets sold, or if it was not sold for whatever reason, it gets thrown out. Essentially, the inventory from the beginning of the year will not remain in inventory by the end of the year. So whatever was the unrealized profit carried forward from last year becomes realized in the current year. Now, when the profit gets realized, the consolidated net income should be higher. Now, how do we achieve that? On the consolidated income statement, we will subtract the before tax amount of the profit. So the before tax amount of the profit is subtracted from cost of goods sold. Now, if you think it through, cost of goods sold is an expense. If we subtract an amount from cost of goods sold goes down. Lower the cost of goods sold, higher will be the gross profit. And everything else being equal, income before tax will be higher as a consequence. Now, if income before tax is higher, the income tax should be higher. And so the tax amount pertaining to the realized profit is added to the consolidated income tax expense. Now, if income tax expense goes up, the result is that the net income, the consolidated net income, is increased, but by the after-tax amount, right? So you add, so if let's say the before tax profit was $100, you subtract $100 from cost of goods sold, your income before tax is higher by $100. Now, if the tax amount were, say, $30, and you add $30 to income tax expense, the net effect of the two adjustments will be net income will be higher by 100 minus 30, $70. That's the procedure by which the realized profit in the beginning inventory is captured on the consolidated statement of comprehensive income. Now, the adjustment is also reflected at an after-tax basis in step 7. So step 7, when we calculate consolidated net income, we add the amount after-tax realized profit amount, depending on whether it was a downstream transaction or an upstream transaction, to either the parent's net income for a downstream transaction or the subsidiary's net income for an upstream transaction. Step 8 relates to consolidated retained earnings. There's no impact there unless we were preparing a beginning consolidated retained earnings. And step 9 is NCI, non-controlling interest. The calculation will not be affected by the beginning inventory amount. For the unrealized profit in the ending inventory, just the opposite is done. So the before tax amount of the profit, we add to cost of goods sold. You add something to cost of goods sold, the expense is higher. The impact is gross profit is reduced. Lower gross profit means lower income before tax. Now, the lower income before tax should mean a lower income tax expense on the consolidated income statement. So we subtract the tax amount from income tax expense. Net consequence is that the consolidated net income is lower by the after-tax amount. However, because of the fact that the company that sold the inventory, so if it was a downstream transaction, it would be the parent company. If it were an upstream transaction, it would be the subsidiary company. Whichever company had originally sold the inventory will have paid income taxes on the amount of the profit. So because the tax has already been paid to Canada Revenue Agency. And it's just for purposes of consolidation that we are making this adjustment. Because the income tax amount has been paid, we add the tax amount to a deferred tax asset on the balance sheet, the consolidated balance sheet, right? Now, for the after-tax amount, there are adjustments. On step 7, we subtract the amount uh, depending on if it was a downstream transaction or upstream transaction. We will subtract the after-tax amount from the parent's net income or the subsidiary's net income. In step 8, also likewise, we will subtract the after-tax amount from either the parent's retained earnings or the subsidiary's um, change in retained earnings. And on step 9, if it were an upstream sale, if this was an upstream unrealized profit, we will subtract the amount, the after-tax amount of the profit when calculating non-controlling interest for the consolidated balance sheet. Next up, we have adjustments for the other intercompany profits. So let's say if there was a gain or loss on an intercompany asset sale, equipment, etc., whatever it might be, and the sale occurred in the current year. So if the intercompany sale occurred in the current year, the amount of the intercompany profit recorded by the seller company is considered to be unrealized and hence needs to be held back. So whatever is the gain or loss reported by the selling company, the before tax gain is eliminated on the consolidated income statement. And the amount of the tax is deducted or added from income tax expense, depending on whether there was a gain or a loss. If there was a gain, the amount of the tax will be subtracted because the gain has been eliminated. If it were a loss, we would add back the amount of the tax benefit because the loss has been eliminated. And the after-tax amount is adjusted in step 7 when calculating consolidated net income in a manner similar to what we discussed for inventory. If it is an upstream transaction, then the amount will be subtracted from the subsidiary company's net income. If it were a downstream transaction, we would make the adjustment to the parent's net income. And again, depending on whether this was a gain or a loss, for a gain, we will subtract. For a loss, we will add back. Now, if we were dealing with the beginning balance, the current year beginning balance of a gain or a loss on an intercompany asset sale, where the asset sale had occurred in some previous year. Well, if the actual transaction had occurred in some previous year, then there's no adjustment needed on the actual consolidated income statement. It's only if you were preparing the consolidated retained earnings and you're looking to prepare a beginning balance for it that you will make an adjustment in step 8. Otherwise, nothing is needed. However, if the intercompany transaction, if the intercompany asset sale was that of a depreciable asset and the asset is being depreciated, then through depreciation, a portion of the original gain or loss gets realized. So what we do in this case is for the depreciation amount on the amount by which the gain got realized, that amount is, so if you stay with me for the gain part, if the gain, intercompany gain is realized, the consolidated net income must be higher. To achieve that, what we do is we make an adjustment to depreciation. Now, depreciation is an expense. To increase income, we want to lower the depreciation expense. So we subtract, minus from the depreciation expense, the amount of before tax realized gain. Now, if the result is, well, my income before tax is higher as a result, then of course, income tax needs to go up. So the amount of the tax on the realized gain portion, we add to the income tax expense. Now, what you're seeing in the brackets is what you would do in the case of a loss. If this was a realized loss will rather decrease consolidated net income. And we achieve that by increasing depreciation expense. Higher the expense, lower will be the profit before tax. And so if it's lower profit before tax, then the income tax should be reduced. And the after-tax amount is adjusted in step 7, just like the inventory. The ending balance of the intercompany asset gain or loss, the adjustment needs to be made to the consolidated balance sheet. So if this was an intercompany gain and there is an unrealized balance, then that is the amount by which the asset is overstated. So to make an adjustment for that, we will reduce the said line, the specific balance of that asset on the consolidated balance sheet. If there was a loss, of course, then we do the opposite. We will add back the amount of the loss. And we have to keep in mind that whichever was this company was the seller company has already dealt with the income tax amount with CRA. So taxes have already been paid. So what we need to do in that case is make an adjustment to the deferred tax asset for the tax amount on the unrealized gain balance. Okay. And this balance is adjusted for in step 9 if it pertains to an upstream transaction. Step 7, the calculation of consolidated net income. So in this step, we are looking to perform an independent calculation of consolidated net income. Now, this step is very important for basically 2 reasons. Number 1, it gives us an amount. It helps us confirm the amount of consolidated net income, which we should get in step 10 when we make the consolidated statement of comprehensive income, i.e. consolidated income statement. So we kind of get an independent calculation that'll help us confirm our answer in step 10. But even more importantly, it helps us calculate how much of that consolidated net income is attributable to the shareholders of the parent company and to non-controlling interest. That's a mandatory disclosure required under IFRS, something akin to earnings per share that you folks learned about in the second intermediate course. Recall that IFRS requires companies to report earnings per share. It's a mandatory requirement. So we have to calculate earnings per share. Similarly, under IFRS, when preparing consolidated income statement, the parent company has to disclose the amount of the consolidated net income that is attributable to the parent company's shareholders and to non-controlling interests. So we are not able to calculate that amount without doing step 7. Now we need information when preparing step 7, we need information from step 3, the amortization schedule. We need information from step 4 for the intercompany dividends received from the subsidiary, and step 6, the amount of intercompany profits that were either realized or unrealized amounts, as we talked about in the earlier step. So how is that calculation done? We start with the net income of the parent company. That net income of the parent company includes dividends received from the subsidiary. So that has to be taken out. The intercompany dividend has to be taken out. As far as the subsidiary is concerned, the dividend came out of its retained earnings. So it didn't show up on the subsidiary's income statement, but because the parent company, recall, follows the cost method, and under the cost method, dividends are considered income, the parent company, when doing its internal record keeping, will have recorded the dividend from the subsidiary as income. So the first order of business is to get rid of that. Remove the dividend from the subsidiary from the parent's net income. Then to the parent's net income, you want to add the amount of realized downstream profits after tax and subtract unrealized downstream profits from the current year, again on an after-tax basis. These two adjustments will result in the parent's adjusted net income. In a similar manner, you will calculate the subsidiary's adjusted net income. So starting with the subsidiary's net income, you want to remove the amortization of acquisition differential because that's an additional adjustment needed on our side. The acquisition differential was never recorded on the books of the subsidiary company. It was an outcome of the subsidiary being acquired by the parent. And since then, every time there is consolidation, the parent company will have been making adjustments for amortization of the acquisition differential. So the amount relating to the current year is taken out from the subsidiary's net income and add the realized after-tax upstream profits and subtract the unrealized after-tax upstream profits, after-tax upstream profits, and we get the subsidiary's adjusted net income. So the subsidiary's adjusted net income plus the parent's adjusted net income gives us consolidated net income. Now, of this amount, non-controlling interests will only receive their percentage share of the subsidiary's adjusted net income. The remainder is attributable to the shareholders of the parent company. Other things to keep in mind, IFRS also requires companies to report earnings per share, both basic and diluted. And if the subsidiary company has preferred shares outstanding, then the amount that belongs to the preferred shares that are considered to be part of non-controlling interest must be taken into account before we allocate the net income to the parent company's shareholders and NCI common. So, that's a slightly complex adjustment. So for the moment, just be aware that there is a possibility if the subsidiary company had preferred shares, then a portion of the net income must be taken out because it'll pertain to the preferred shareholders. Step 8, we want to calculate consolidated retained earnings. And that's needed because it is to be reported on the consolidated balance sheet. So the information needed for this step comes from step 3, the amortization schedule, and step 6, which deals with intercompany profits. Now, if we are required to prepare a consolidated statement of changes in equity, then the beginning consolidated retained earnings for the year is required to be calculated. Otherwise, we can directly calculate the ending consolidated retained earnings. If the consolidated statement of changes in equity is not needed, then I recommend that we do a direct calculation for the ending consolidated retained earnings. Now, in this particular slide, I'll show you how, if you were to calculate the beginning consolidated retained earnings for the year, how you can get to the ending consolidated retained earnings from that point. It's a lengthier calculation. I will show you a shorter calculation in the following slide. So first up, if you were to calculate the beginning consolidated retained earnings, you will begin with the parent's retained earnings at the beginning of the current year. So I'm just, for exposition purposes, I'm saying that's year 5, Jan 1st, year 5. From the parent's retained earnings on Jan 1st, year 5, you want to take away unrealized beginning downstream profits. Again, This adjustment should be after taxes to get the parent's adjusted retained earnings at the beginning of the year. Then you'll take the subsidiaries' retained earnings at the beginning of the current year, subtract from it the subsidiaries' retained earnings on acquisition date. Keep in mind the subsidiaries' retained earnings on acquisition date was taken into account when calculating the acquisition differential. So it is important to remove the subsidiaries' retained earnings on the acquisition date from the subsidiaries' retained earnings in the current year. Otherwise, we will be double counting that amount, minus the amount of the subsidiaries' retained earnings at acquisition date to get the change in the subsidiaries' retained earnings since the date of acquisition. From this amount, we will subtract the accumulated amortization of acquisition differential from the date of acquisition, say that was year one, Jan 1st, year one, up to the end of year four, i.e. up to the end of last year. We will also subtract any unrealized beginning upstream profits, and that must be after taxes. So these two adjustments will give us the adjusted change in the subsidiaries' retained earnings. Multiply that by the parent company's share, you get the amount that will be added to the parent's own adjusted retained earnings to give consolidated retained earnings beginning of year five. Now, we can go from the beginning consolidated retained earnings balance to the ending consolidated retained earnings balance. And that's a calculation that you learned first in your introductory accounting classes. That's basically the calculation of retained earnings. So beginning retained earnings, add net income, subtract dividends gives you the ending retained earnings. In a similar vein, if you have the beginning consolidated retained earnings, add consolidated net income that is attributed to the parent company, and subtract dividends declared by the parent company. And you get consolidated retained earnings at the end of year five. Now, this is a lengthier calculation, and you can do this if you want, but on an exam, you may be stressed for time. And so there is a shorter calculation possible. So the direct calculation of ending consolidated retained earnings, if you wanted to do that, here you will start with the parent's retained earnings on December 31st, year five. So, if you were doing this calculation for year five, December 31st, so start out with the parent's retained earnings at December 31st, year five, directly, subtract the unrealized downstream ending downstream profits after taxes to get the parent's retained earnings, adjusted retained earnings as of December 31st, year five. So notice the difference between what we're doing here and what we were doing in the earlier slide was um, the retained earnings, which date the retained earnings you were picking up for, and of course, what adjustments you were making. So in that case, you were taking the unrealized beginning downstream profits. Here, you're making an adjustment for the unrealized ending downstream profits. Likewise, for the subsidiary, you take its retained earnings on December 31st, year five, subtract the retained earnings on acquisition date, as I explained. Otherwise, you will be double counting the retained earnings on acquisition date, and that'll be problematic. You get the change in the subsidiary's retained earnings since the date of acquisition. Subtract from that the accumulated amortization of acquisition differential from the date of acquisition up to the end of the current year, from year one to year five, and subtract the ending upstream profits after taxes to get the subsidiary's adjusted retained earnings on December 31st, year five. Multiply that by the parent company's share, and you get an amount that will be added to the parent company's own adjusted retained earnings to get the consolidated retained earnings December 31st. So this is a much shorter calculation compared to the one we saw on the earlier slide. For exam purposes, I'd recommend that you do this direct calculation. Next, we calculate non-controlling interest for the consolidated balance sheet. NCI is to be reported as part of shareholders' equity, must be shown separate from the parent's shareholders' equity, though. On the date of acquisition, non-controlling interests were allocated their share of the subsidiary's book value along with acquisition differential. Now, from that time, the non-controlling interest share claim will have changed according to the principles of the equity method, i.e., it would have gone up by their share of the equity method income, decreased by their share of the dividends from the subsidiary. So the calculation for NCI needs to incorporate those elements. Where do we get information necessary for that? Well, other than, of course, the information from the balance sheet, the standalone balance sheets, we also pull up information from step 3, the amortization schedule, and step 6, only the upstream profits, though. We only pick up the upstream profits for this purpose. And here's how the calculation goes. You take the subsidiary's net book value on the date of calculation. So this is December 31st, year 5. Net book value is basically common shares plus retained earnings. To this amount, you want to add the unamortized acquisition differential from step 3. This is the one coming from the last column in step 3, the rightmost column, and subtract any unrealized ending upstream profits, not downstream, just the upstream profits. So whatever adjusted amount you get, multiply that by NCI's share to get non-controlling interest for the consolidated balance sheet. So this calculation is fast. However, there are people that find it harder to kind of remember different calculations. So it is possible to use a variant of the consolidated retained earnings calculation to calculate an NCI as well. So here's the alternative calculation of NCI using the the layout of the consolidated retained earnings calculation. So all that is needed is that you substitute for the parent's adjusted retained earnings, you substitute it with NCI on acquisition date. Everything else remains the same, i.e., you take the sub's retained earnings at the end of the current year, subtract the subsidiary's retained earnings on acquisition date to get the change in the subsidiary's retained earnings since acquisition. Subtract the accumulated amortization of acquisition differential from the date of acquisition up to the end of the current year, and any ending upstream unrealized profits to get the subsidiary's adjusted retained earnings at the current date. Multiply this by NCI's share, and the amount that you get, if added to NCI on acquisition date, gives you non-controlling interest to be reported on the consolidated balance sheet on December 31st, year 5. Next up, step 10A is the consolidated statement of comprehensive income. To prepare this, you need information that comes from the parent and the subsidiaries' standalone company income statements. Step 3, the amortization schedule. Step 4, which had the intercompany revenues and expenses for elimination. Step 6, the intercompany profit information. And step 7, basically for two purposes. A, the total should match, and then the amount of consolidated net income attributable to the parent and to the NCI, because that is a required disclosure under IFRS. Preparing the consolidated statement of comprehensive income, here are some of the common adjustments. So first up, to consolidated sales, you must make an adjustment. You must subtract the intercompany sale of goods. So if there was intercompany sale of goods identified in step 4, you will subtract that amount from sales. From other income, you will make adjustments for dividends received from the subsidiary. These have to be eliminated, so you subtract. Any intercompany management fees, royalties, etc. charged, you need to eliminate, so you'll subtract that amount. And then if there was a sale of an asset intercompany in the current year, and there was a profit or a loss recorded, then you will eliminate the amount of that profit or loss as well. So you will subtract the amount of the gain recorded, add back the amount of the profit recorded, if any. And from step 6, if there were any realized gain on land, because land is non-depreciable, any realized gain will be added. Any realized loss will be subtracted. That goes without saying, but that adjustment has to be made before tax. From cost of goods sold, you will take away the same amount that you subtracted from sales. So minus the intercompany sale of goods, the same dollar amount needs to be subtracted from cost of goods sold. Okay? So please do not fall for, if a gross profit margin is given, etc., do not start calculating the cost specifically. From the consolidated cost of goods sold, you will subtract the same dollar amount as you deducted from sales. And that should be at selling price. Okay. And then for the inventory that remains unsold, there will be two things. The beginning inventory that got realized. So I talked about that earlier in step 6, calculations for step 6. You will subtract the before tax profit from cost of goods sold and add any before tax ending inventory profit to cost of goods sold. So cost of goods sold is going to have 3 possible adjustments. Then to depreciation expense, you will add the amortization of acquisition differential if that was a debit adjustment, or subtract if it were a credit adjustment. And that comes from step 3. That should relate to depreciable assets, not for land or anything else. It should just be for the depreciable assets, so equipment, buildings, and such like. Also from step 6, if any of the intercompany gain got realized, then we will subtract the amount of the realized gain from step 6. If there was a realized loss, we will add the amount, and that would be before tax. Next, from interest expense. Okay, so interest expense, we will make an adjustment. From step 3, the amortization of fair value difference related to long-term liabilities, you got to make an adjustment there. So if you have a debit adjustment, you will add to interest expense. Credit adjustment, you will subtract from interest expense. Goodwill impairment noted in step 3. This should be reported separately unless you're otherwise told. Sometimes the problem will say goodwill impairment is included in cost of sales. Well, then you'll have to make an adjustment there. Or you might be told goodwill impairment is included in administrative costs. Well, then you will put it there. Otherwise, the goodwill impairment should be reported as a separate line item. So you'll have to add a line item on the consolidated income statement. From other expenses, you will take away the intercompany management fees, royalties, etc., that you identified in step 4. And income tax expense, the adjustments will all come from step 6. So add the tax amount for the realized beginning inventory profit, subtract the tax amount for the unrealized ending inventory profit, and then so on for the other intercompany profits. Step 10B, the consolidated balance sheet. You get information for this from the parent and the subsidiaries standalone balance sheets. Step 3, the amortization schedule. Step 5, intercompany receivables and payables that must be eliminated. Step 6, the intercompany profits. Step 8, for you get the amount for consolidated retained earnings at the end of the year. And step 9, the non-controlling interest for the balance sheet. The common adjustments included here relate to the accounts receivable, accounts payable. These are eliminated. The amounts identified in step 5 are eliminated on the consolidated balance sheet. Capital assets, so building, equipment, land, etc. If there are unamortized acquisition differential balances from step 3, a debit amount will be added, a credit amount will be subtracted. And then from step 6, if there's unrealized gains, we want to subtract the amount of the before tax unrealized gain. For an unrealized loss, we will add it back. The investment in the subsidiary account is excluded, so it's not to be included on the consolidated balance sheet at all. For deferred tax asset, we will include tax amounts on ending unrealized profit balances. If there is an unrealized loss, well, that would be a negative. So you would want to subtract. In some extreme cases, the amount of the loss, the tax on the loss is greater than the tax amount on the other unrealized profits. So if the loss balance is greater, then basically that amount will end up becoming a deferred tax liability. Goodwill is to be included from step 3. Liabilities, looking at if there's any unamortized balance from step 3, a debit balance from step 3 will result in the liability being lowered, so minus. If you have a credit balance, i.e. a negative in the amortization schedule, well, then that will be added. Common shares reported should be the parent company's common shares only. The subsidiaries' common shares are eliminated. Retained earnings should be the consolidated retained earnings as calculated in step 8, and non-controlling interest should be the amount as calculated in step 9. Sometimes the balance sheet information that you're given will include information pertaining to accumulated depreciation. So my recommendation is that if that is the case, you should simply be using the net amounts. So take away the accumulated depreciation from the cost, use the net book values, everything will be straightforward, everything will be easy. If, on the other hand, you wish to report the accumulated depreciation amount, or say you have a connect assignment problem that requires you to do so, then you have to do some calculation. The cost of the property, plant, and equipment in that case, for purposes of the consolidated balance sheet, will become the parent's cost plus the subsidiary's cost of that particular item. You want to subtract the accumulated depreciation that the subsidiary's balance sheet had for that PP&E item on the date of acquisition. That information will be provided in the problem. So subtract that amount and add the fair value difference allocated to that PP&E item on the date of acquisition. All right, so that gives you the new cost for consolidation purposes. And for accumulated depreciation, you'll take the parent's accumulated depreciation plus the subsidiary's accumulated depreciation, remove the accumulated depreciation that existed on the subsidiary's books on the date of acquisition, and instead replace it with the amortization of the fair value difference on that item up to the current year end, from the date of acquisition up to the current year end. I do not recommend trying to do this unless absolutely necessary. it would be much easier if you just use the net amounts, as I said in the first bullet. The consolidated statement of changes in equity, it's prepared in a manner that is similar to a separate company statement of changes in equity, i.e., you typically lay it out in a columnar form. You have various items of equity listed in each of the columns. So because it's a consolidated statement of changes in equity and non-controlling interest is considered part of shareholders' equity, you will have a separate column, an additional column for non-controlling interest. If there are changes in the ownership of the parent and NCI, and it's something that we will be covering later on in topic 13, these will be reflected in the consolidated statement of changes in. So for now, that's all you need to know about the statement of changes in equity. The consolidated statement of cash flow is also prepared along the lines of a separate company statement of cash flow. Now, there do tend to be some items that are unique to consolidation, and these relate to the adjustments related to amortization of acquisition differential. So these are typically treated the same way as you would depreciation. So if you're beginning with consolidated net income, you will add back the amortization of the acquisition differential. The second item is dividends paid by the subsidiary to non-controlling interests are reported on the financing activities portion, and this would be in addition to dividends paid by the parent company. So you'll have two amounts related to dividends. You'll be showing dividends paid by the parent company and also dividends paid by the subsidiary to the non-controlling interest. Dividends paid by the subsidiary to the parent company, recall, are eliminated for consolidation. It's just the amount paid out to NCI. And if there were a change in the parent's ownership percentage that we alluded to in the earlier slide, that's something to be covered in topic 13. Then cash flows related to that change are also reported in the investing activities section. We will cover the consolidated cash flow statement later on in topic 15. That concludes this lecture video on topic 7. It is a long video. Thank you for watching to the very end. And I look forward to taking up consolidation subsequent to acquisition in class, the examples. These tend to be long examples. So you have done yourself a good favor by watching this lecture video to the very end. Take care. Bye-bye.